Hello and welcome to the Monday Futures Market Outlook for November 5th, 2012. This is Patrick Ceresna. For those of you that have not had the opportunity to try out our eMoneySource.com trading room, 5-day complimentary memberships are available on the website. We've recently taken our intermarket analysis and put it together in a fabulous market timing strategist newsletter. If you'd like to learn more about that, visit our website, markettimingstrategist.com. As always, we start off with a chart of the US dollar index futures, and after banging out a short-term bottom along the 79 level down below, we have now seen the US dollar working its way higher, including a substantial push higher on Friday after the jobs numbers. Really at this stage we continue to have the same outlook that we were looking for the dollar index to retrace up in towards this 81 to 82 zone, and we are starting to approach those zones as we speak. There is still room for the dollar index to continue to strengthen, especially if the euro makes that move down towards the 126 level on the downside, but we're slowly going to become cautious with the dollar index as it strengthens up into these zones. So next year, when we take a look at that euro, you can see why the dollar index strengthened, because the euro had a really good breakdown day. It still has yet to break down that key support line that marked off all of its lows during the September and October bottoms. But really, if this accelerates anyway through this level on the downside, then there's room for us to see weakness down to 127, 126, or even 125 on the downside. We believe that overall the euro needed a proper consolidation, and we're probably going to get one in here that is going to leave the euro range bound for more or less the remainder of the year. Next here I want to take a look at the 30-year Treasury bonds, and surprisingly the Treasury bonds have been very non-committal. In fact, they're sort of stuck in a major scrum with a Fed intervention on one end and very low interest rates on the other, and more or less the range-bound price action has become very evident. While we could create a bias either higher or lower here, there's very little merit at this point to putting a strong bias until we see where there's some legitimate follow-through momentum, and then we can kind of measure out where the likely targets are to be. But we're going to remain very cautious and down the middle of the road here with the Treasury bonds until we see some price action that we can actually measure out. Next year, when we take a look at copper had a major support line here at the 352 level, and we currently are breaking down below that level. This is a crucial moment. I mean, if we see a big recovery come Monday, Tuesday, then that could take it off the table. But here, any further weakness could see copper deteriorate down to 335 or even down to 3 1/4, where the lows all came in June and August. So it'll be very important to see what can happen here. Just like when crude oil broke that support line, it really just continued selling from that point, and we're going to be seeing whether or not copper is following suit there. So when we look at crude oil, you can see that crude oil, we were looking originally even a month or two ago about how important that 89 support line was, and that if we saw crude oil bang out its bottoms, it could see a rally that can push back to 98 or 100 on the upside. But with the way that crude oil broke down below that zone, and especially the deterioration we saw on Friday, there continues to be vulnerability for crude oil to not weaken all the way back down to the $79 level, give or take, along those lows that occurred back in June. And while it's not always a guarantee, there's a very high probability at this point that further weakness will continue to demonstrate itself here on crude oil. Next year, when we take a look at gold futures, we were looking for gold to consolidate down to the 1650 to 1700 level for the next good buying opportunity, and we find gold trading down into here. Interestingly enough, it'll be while we're looking for a buying opportunity in gold, a lot of the other commodities remain very distinctly weak, which makes us at least a little bit cautious here. While we're not suggesting that it is not a buying opportunity, but it probably may warrant just waiting to see how far and how low gold goes on the short term before we accumulate it, and we probably want to see a few stalling days and demonstrate that the momentum that came in on Friday has really stopped, but at some point we will probably be buying the dip here on gold. Next here, when we take a look at the S&P 500 using that E-mini futures contract, we had that big reversal off the jobs number, and while we would be normally negative on the next few days based upon that, it'll be very interesting to see whether or not the U.S. elections will cause far more range-bound price action rather than any further momentum. Nonetheless, even after the elections, we do anticipate the markets to still have the potential to test down into the 1340 to 1380 area to complete what would be a solid 5 to 10% market correction. When we get down into those levels, that may emerge as a substantial buying opportunity, but at this stage we continue to believe that the market remains vulnerable for further rounds of weakness, and we'll be looking to capitalize on that. Just to make our key intermarket observations, we left everything unchanged right now, but we are very close to changing a number of these. First off, the US dollar, while our short-term risk reward was good for the last month, looking for that US dollar strengthen as we now approach that 81-82 level on the dollar index. This certainly is going to put the dollar index into far more of an average, if not even poor risk reward proposition. So you'll see us in the upcoming weeks take that down. In regards to commodities, we could certainly change that from average to good, as many of these commodities are weakening in the next and in the next week or two. If we see even further weakness, we may see that many of these commodities come to a level where we can justify them as a buying opportunity and change our outlook to a good risk reward proposition. And that's same for US stocks and global stocks, as we see further weakness in these markets. Our poor to average risk reward propositions that we've rated on them will suddenly become good, and we will look to be buyers of the market. And so we'll see some minor shifting as many commodities and US stocks and so on will become attractive, and the US dollar will become a little less attractive in this cycle. So we'll watch to see how the markets continue to play out, and then when that shift will occur. It might be as early as next week, but could even take 2-3 weeks for that whole cycle to play out. That was your Monday Futures Market Outlook. Thank you for joining us.